Bloomberg Audio Studios. Podcasts, radio, news.
So here we are.
I guess we're on the clock. It's been approximately 6 months since we've recorded a podcast together.
Right. It's good to see you.
It's nice to see you. You look rested. You got a haircut. You're clean shaven.
Yeah,
you have a tan.
Yeah. No, it was nice. I missed the podcast, of course, but it was nice being on vacation.
You're so full of it.
Yeah. We're both being incredibly insincere. Yeah, here we are.
I will say it was nice to, roll into Thursday the last 2 weeks and been like, oh my God. And then have been like, oh, wait, no, everything's fine. I don't have to record anything right now.
I share that feeling. And also this Thursday was not like that.
Yeah. We should set up a Patreon.
Hello, and welcome to the Money Stuff Podcast, your weekly podcast where we talk about stuff related to money. I'm Matt Levine, and I write the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
Yeah, Taylor Swift got engaged.
Yeah, biggest financial market news of the week. Pretty surprising, but not to at least one person named Romantic Paul.
Several people sent me this thing. So a guy made a well-timed
You assume
trade.
It's a man.
Yeah. A user with the account name Romantic Paul made a well-timed trade on Polymarket on Taylor Swift getting engaged. Basically, that contract was trading at 25%, and then it spiked up to 40-ish%, the day before she got engaged.
Yeah.
And several people sent that to me, and people were interested in that stuff. But that was a contract with a couple of $100,000 of bets outstanding.
Yeah.
And Romantic Paul seems to have made on the order of $3,000 on this well-timed trade. So was it the biggest financial market news of the week?
Oh, no, I'm just talking about the magnitude of Taylor Swift getting engaged.
Right.
Sending ripples across all financial assets.
You're saying treasury is sold off.
Yeah.
Okay.
Yeah. You didn't need a Haven asset in that scenario. America's back, baby.
I saw your tweet. You're bearish and Taylor Swift got engaged and you're bearish.
You're bearish. Taylor Swift got engaged and you're bearish.
It's just a risk-on moment.
Yeah, absolutely.
Okay, I'm sorry. I take it back. I was just talking about the narrow.
No, that
so many things. It's prediction markets. You can specifically bet on or hedge a specific thing, but then those things often have broader financial market implications, and so you can structure your Taylor Swift trade by buying the S&P.
I have to say, I am surprised that it was only about 25% odds. I wish I had known that it was trading that cheap.
Yeah, it was she gets engaged by the end of this year.
Yeah.
Yeah.
So,
I agree. That seems cheap.
It does seem, especially right now when she's engaged. After the fact, for sure.
I knew that all along.
You raised the point that she got engaged 2 weeks ago. So theoretically, someone probably knew.
Yeah.
So maybe there was an element of insider trading here.
Yeah, although again, the amount of money that you could make insider trading on the Taylor Swift engagement news is in the single-digit thousands of dollars.
Single-digit thousands?
Yeah.
What if you can you lever these bets?
The problem is finding people to bet against you, right? It's a prediction market, and to bet on yes, you have to find people who are willing to bet on no. And, the number of people who want to put millions of dollars into betting that Taylor Swift won't get engaged against a highly motivated buyer is
That's true.
Slim.
I guess if you knew for sure, you'd probably just sell it to a tabloid. But
Right. Or
you could make a lot more
money. Or just
there.
be friends with Taylor Swift. Just seems like a lucrative.
Yeah. There's a few things that point to this being not insider trading or a person who didn't know for sure.
Yeah.
We were just joking. In hindsight, of course, it seems obvious. But also, they got engaged theoretically right after they
recorded a podcast together.
Recorded a podcast, actually, with the Kelsey brothers. Funny how that happens. Maybe I'll go repropose to my husband after this. But anyway, Taylor Swift, sorry, this is for the Swifties out there, she hasn't done an interview like that with a previous romantic partner of that scale. This was an hour. I don't think
she's ever dated a podcaster before. Maybe I'm wrong. I'm probably wrong.
I know, but she's dated other famous people where theoretically they could have done a joint appearance that.
Yeah, but they didn't have a podcast.
I know, but they could have found a podcast to go on, is what I'm saying. She hasn't sat in an interview or done anything like that with previous partners. Okay. So you could watch the New Heights episode, which millions of people did, be like, oh, wow, these two people clearly like each other. And the bet was that they would...
I really love that. Like, you're like,
No, I
you
thought
had to
about
know they were getting engaged because they podcasted together.
Well, no, it was also a video podcast, which
podcast.
By the way, we should
sure.
probably
Yeah.
do more of. Anyway, you could really read their body language. But probably maybe if you want to give Romantic Paul the benefit of the doubt, he saw that podcast, was like, oh, shoot, these are two people who genuinely like each other. And the bet was that they'd get engaged sometime this year.
Yeah.
It's only August.
Yeah.
Yeah. And they're 35 years old.
Yeah. You make good points.
Thank you.
I don't mean to suggest that Romantic Paul was insider trading to make $3,000 on Taylor Swift's engagement.
$3,500?
Prediction markets are so weird and interesting and so like growing in importance in strange ways. And I think, the contours of insider trading around prediction markets are very strange.
Yeah.
I think of it mostly in connection with sports betting, right? Because, and this is not a sports bet.
It's
sports adjacent. Travis Kelce is a sports figure. But I have written a lot about, and we've talked about how prediction markets are an interestingly important way to make sports bets because it seems like right now, CFTC regulated commodities futures markets like Kalshi are a way to make sports bets that are not subject to state regulation. So you can ignore state gambling laws and get better tax treatment than actual gambling. Because right now, gambling losses are not fully deductible on your taxes, but commodity trading losses are probably fully deductible. So the prediction markets, like particularly Kalshi, are having a real moment for becoming the sports gambling platform. And, this week I wrote about Robinhood is suing Nevada regulators so that they can be allowed to offer sports gambling. Robinhood wouldn't say this, but I would say.
No.
So they can be allowed to offer sports gambling on their stock trading app, which is kind of amazing, but just sort of where things are heading. And prediction markets are beloved by economists and libertarian weirdos because in theory, if you had a prediction market on everything, then you could predict everything and the world would be better informed because markets would push prices to their correct place. And there's a lot of skepticism about that because in fact, people don't want to bet on all sorts of nonsense. Mm-hmm. And the big problem with prediction markets has always been outside of the US presidential election, it is hard to find a lot of people who are really into betting on prediction markets because it doesn't sort of serve any savings purpose. And it's not a natural home for gamblers. And so the volumes on prediction markets are kind of small and you can have your doubts about how predictive the prices are, again, outside of the US presidential election. And when prediction markets get into the sports gambling game, that changes that dynamic entirely, right? It means that if you look at Kalshi and you think this is the future of sports betting because it has a better regulatory and tax treatment than the sports books that are doing billions of dollars of bets, then you're thinking Kalshi is going to offer people gambles that they want and that they come back to every day, right? Because sports are constantly happening. And so then all of the ancillary stuff, all of the stuff like betting on Taylor Swift's baby is just more appealing because more people have Kalshi accounts and more people are, betting there anyway. So they'll bet on when the wedding will happen. And,
the network effects will kick in.
Yeah, the network. And so, people will be betting on everything. And then, you'll have a CFTC regulated licensed U.S. commodities exchange for sports betting. And then what happens when people start, making insider bets on sports or on Taylor Swift's engagement?
I should know this, but have DraftKings and FanDuel, have they tried to offer stock betting on their platforms?
Yeah, a little bit.
That's funny.
Flutter, which is the parent company.
A FanDuel, right?
A FanDuel, yeah. They're working on some sort of partnership with CME to offer essentially sportsbook bets on financial outcome. Will the S&P be up or down today? Because, for one thing, if you're a gambling platform, offering people more bets is just more appealing, right? You just you have more touch points. And then for another thing, if you're a gambling platform and you look at what Kalshi is doing, you have to think, maybe we should be in the futures trading business rather than the sportsbook business because it's the same business, and it gets better tax and regulatory treatment.
Man, that's pretty wild.
Yeah. There's just a lot of convergence between gambling and financial markets.
Parallels here to private markets becoming the public markets.
The betting markets are becoming the financial markets. Yeah.
All of the Venn diagrams are just turning into circles.
It's all just bets.
Before we leave this topic, talking about whether or not this is insider trading, or if it could be insider trading, you wrote that if Romantic Paul is Travis Kelce, that's fine. Is that fine?
This is not legal advice.
Go on.
This is going to depend a little bit on like the specific terms of service of the platform, right? I mean, Polymarket has a kind of vague terms of service. But if you think about, and this is not a CFTC regulated exchange, but if you think about the future that we'll live in where all betting takes place on commodities futures
I look
exchanges,
forward to that future.
Then the way commodities insider trading rules work is if you misappropriate information from someone else, then that's illegal. That's illegal insider trading. But if you own the information, it's harder to say that you're insider trading. So if you're an oil company and you drill a lot of oil and like, your well is a bust and you think, oh, that's going to push up oil prices, you're allowed to buy oil futures because the point of oil futures is to allow actual oil producers and consumers to sort of hedge their actual production and demand. And so, of course, you're trading in inside information about your own behavior.
Right.
If you're like a trader at an oil company and you're front running your company by buying futures for your own account, that's illegal insider trading. And there are cases, right? There are cases of people who are front running, who are misappropriating information, get in trouble for commodities insider trading. But just the owners of the commodity, like the commodity producers, are allowed to trade on their own information. So I don't know where that leaves you when your commodity is like, will Taylor Swift and Travis Kelce get engaged?
Will I engage or will I propose to Taylor Swift?
Right. But I think it kind of leaves you like, yeah, go ahead and trade on that. Again, there's like no money here, right?
There also is a risk. I was going to say, because he didn't know that she was going to say yes.
Of course there's a risk, right?
But
insider trading, whatever.
Yeah.
Insider trading is rarely 100% risk-free.
Also, she had already said yes by the time these were made.
Right.
But I was thinking more of the example of he's the CEO of a company and he knew that earnings were going to be good, but they hadn't.
That's not the CEO's information. That's the company's information.
Oh.
And by the way, companies can't really insider trade their stock. Like in stocks, the rules are kind of different. Like in stocks, companies have a fiduciary duty to shareholders and they can't really insider trade their stocks. But in commodities, that's a little bit.
We're talking about commodities, not stocks, not equities.
Yeah.
Congratulations.
Commodities like Taylor Swift's engagement.
Congratulations, Taylor Swift, from your friends at the Money Stuff Podcast.
Come on the pod.
Yeah, come on. It worked out really well, your last podcast appearance. Do you want to talk about Michael Saylor? Yeah, this is a guy that we talk about sometimes. And his company, Strategy, not MicroStrategy.
Strategy.
Yeah, its premium is collapsing before our eyes.
I know. I feel a little bad about that somehow. I don't know why.
Did you cause that?
No, but like I've like made fun of this premium for years and years, and now it's collapsing before our eyes. And I'm like, I don't wish ill on anyone. I want them to keep running this ridiculous strategy for as long as they can.
Strategy.
Strategy.
I mean, it's been kind of depressed for a while.
Yeah.
The premium, the MNAV.
The MNAV.
Yeah. Well,
they love like, you have to like sort of put a lot of science around things like this. Because like Strategy's business is like, they buy a lot of Bitcoin, their stock trades at like twice their net asset value. They sell more stock to buy more Bitcoin. Then the net asset value goes up, the stock goes up by 2 times as much, and it's a like perpetual flywheel. But now instead of 2 times, it's like 1.5-ish times. And so
1.4 last I checked.
Yeah. So it's like this trade is a magical money printing machine when you can sell stock at a big premium to your net asset value. And it's like a terrible disaster if you can sell stock at a discount to your net asset value.
Yeah.
And as you come down, it's like less and less fun.
Yeah.
So they actually, like, I think they put out guidance that they would not sell stock at less than 2.5 times net asset value. And then when the premium went below 2 times, they're like, well, never mind. We'll just keep selling stock at, whatever we can get.
Yeah. So I have to say, I don't really understand why they did that because
it's at 1.1 times it's a good trade.
I know, but no.
You can like sell, at a premium. You should sell at a premium.
I know, but okay, they pledged to
They said they wouldn't, but that was when things looked great.
But they were already below 2.5 when they said that.
Okay, but like the other reason, so sorry. Right.
And there was a 2-week span there.
Yeah. So
like they said they wouldn't do this, 2 weeks later they did, and they were already below 2.5 times.
Yeah. Okay. So there's two questions, right? One is why would you sell stock at below 2.5 times net asset value? And the answer is because if you can sell stock at any premium to net asset value, it's a good trade, right? It's accretive to your shareholders to sell stock for more than it's worth. And then the other question is why did they say they wouldn't sell?
That's what I don't understand.
Okay. So there's two answers to that. One is the whole game here is like investor confidence, right? So if you can say, oh, it's always going to be at a premium, then investors will like your stock and the stock will go up and it'll be at a bigger premium, right? So one thing is you just have to like tell people what they want to hear because you're in the business of selling them stock at a premium.
For sure.
But then the other reason is that they're not exclusively in the business of selling stock. They have gotten really into doing weird capital markets trades that I love as a former weird capital markets banker. And so they've found all sorts of like straight preferred stock deals to do, which is like tech companies don't do big straight preferred stock deals. That's not a thing. Like straight preferred stock is not a real instrument outside of like financials and a few other weird places. And they were like, we're going to sell billions of dollars of preferred stock because essentially it's like borrowing money perpetually at, call it 9%, 10% interest to buy Bitcoin. And if you think Bitcoin will always go up by 50% a year, then borrowing at 10% to buy Bitcoin that yields 50% is a great deal.
Yeah.
And so they've been doing a lot of preferred stock deals. And I think when they said we're not going to sell stock below 2.5x, they thought we'll just do fixed income financing to keep buying more Bitcoins. And then the market for that softened.
Yeah.
Because like it's such a weird market. Like people don't need billions of dollars of preferred stock of a tech company that buys Bitcoin. And so when that market collapsed, they're like, we still need to buy more Bitcoin. So they're selling stock again.
Yeah. It's funny. Who would be the typical buyer of preferreds?
I have never really known that. I mean, it's like income oriented. You know, if you're a retiree and you can get 9% yield, that's great, you know?
Yeah. Well, apparently there's not enough of those people because they're recent
billions of dollars with like, you know, like that credit profile.
Yeah.
It's a weird trade.
Their most recent sale raised just about like $47 million.
Yeah. And the stuff they're doing is, I mean, for me, I love it. Like their most recent thing is
You're not buying enough of it.
I haven't bought any of it, but like it's a floating rate preferred that the rate floats with just like their feelings. Like the rate floats with, they want to keep it to trading at par. And so the rate will float at whatever makes it trade at par, which is like essentially floating with their own credit, which is a truly insane instrument that no one has ever done before. That like Michael Saylor is like, I'm going to do this. And so I shouldn't say no one's ever done it before. It's kind of auction rate preferred. But it's very strange and very cool and fun for capital markets nerds. But like they don't buy billions of dollars of preferred stock.
Yeah. Yeah.
And also, by the way, when I say something is cool and fun, that means I would not buy it.
Yes. Okay. That's a necessary disclosure. There's also the question of why the premium is collapsing. I mean, taking a look at Bloomberg News coverage, one of the reasons pointed
it's like overdetermined, but go ahead.
is that there's just so many crypto treasury companies.
Right.
But how much is that truly diluting demand for strategy?
So one thing that's interesting is like, you know, people thought that the premium would collapse when spot Bitcoin ETFs became a big thing, and it didn't really.
Yeah.
And I think the reason for that is like, they really are two different trades, right? A spot Bitcoin ETF is like you can buy Bitcoin and you want exposure to Bitcoin, so you buy Bitcoin. MicroStrategy trade is you can buy stock at a premium so that they can sell more stock at a premium so they can accumulate more Bitcoin. Like you're really just betting on this is a company that can sell stock at a premium to buy assets, right? I think that's the bet. And that bet is very circular and strange, but it was hard to find, right?
Yeah.
And it's not replicated with a Bitcoin ETF, right? Like that's just the bet on Bitcoin. Strategy is a bet on selling stock at a premium.
Straight exposure.
But now you can find that bet anywhere. There's like hundreds of companies that are like, oh, we've got a way to sell stock at a premium. And some of the people who are gambling on the generic concept of like ability to sell stock at a premium to buy crypto are, you know, doing it with other crypto companies that have higher premiums or lower premiums.
Yeah.
There are more flavors of that bet, and there are only so many people who want that bet.
That's true.
So I think that's part of why the premium is not doing as well. But also just like, I really think that this is the sort of thing where if you think about it for a minute, you'll be like, ugh.
Yeah, don't do that.
And so you look at like, you know, Jim Chanos betting against this. It's just like some of the people who look at this who have my or Jim Chanos's cast of mind are like, this is crazy.
Yeah.
And, enough of those people say that, then maybe like people stop buying it at 2.5x.
It is fun to think about, okay, let's say that the strategy premium does erode even further, what this means for this ocean of crypto treasury companies that now exist. Are you just going
they're all the numbers that people have announced for like their plans? It's the tens of billions of dollars of crypto treasury plans. Like, that's not going to happen. Like,
we'll see.
Like, it's just not like they're not going to raise that kind of money. I think some of it is like people have converted their stashes of crypto into crypto treasury companies because like it's trading at a higher value. And if that erodes and it ends up at a zero premium, then they'll own a stash of crypto in somewhat inconvenient form. And it's like kind of fine. Mm-hmm. But the people who are like, we're going to go sell $20 billion of stock at the market to buy Dogecoin.
Yeah, you are.
They're not.
So what does that mean? We're just going to have like a watery graveyard of companies that are trading at a discount?
Strategies is a different story, right? Because it's a real company with, eccentric management. But a lot of crypto treasury companies are sort of more or less defunct like biotech companies that had like a, $1 million market cap and then got acquired so that someone could pump $1 billion of crypto into them, right? Before there were biotech companies, there were gold miners, right? There's like a long history of watery graveyards of public company tickers being passed around. And let's go back to that, right? So like the fad this year was crypto treasury companies. The fad 2 years ago, it's like fine.
Yeah. Okay.
It's fine.
I feel better.
Yeah. Crypto treasury companies are quite harmless. Mm-hmm. Like, they're
not like negatively impacting the economy.
No. I mean, in some broad sense, yes. But like, it's not like a crisis could occur in crypto treasury companies. Okay. Right? Like, if the strategy trade stops working, like the worst case is kind of it trades to like 80% of net asset value, right? Mm-hmm. That's still like, many tens of billions of dollars company, right? Like they've really pumped a lot of, I don't know that I want to say real value, but in quotes, real value into this small software company.
Got a lot of Bitcoin.
They've got a lot of Bitcoin.
At the end of the day.
At wherever we are in the day. Yeah.
Okay. Well, on the long list of things to worry about, I will put that at the bottom. IPOs. Matt, you wrote about a paper. It came out of Joseph J. Henry of Northeastern University and Terrence M. O'Brien from the University of Maryland. And I realized that you're biased here because they quote you right off the bat.
That's true. I probably should have disclosed that in my column.
No, I think that's awesome.
I am biased here.
It's like an Easter egg if you actually go to look at the paper that you're referencing.
I think sometimes that there are a lot of like finance and law papers on SSRN that have, 12 downloads. Mm. And
this one has more than that.
Sometimes, right, I don't mean to talk about this one specifically. Sometimes I come across these papers in various ways, often because the writers send them to me. Mm-hmm. And then I write about them in Money Stuff. And then they have more than 12 downloads. And I don't know how directly useful Money Stuff mentions are for like academic tenure, but like there's going to be some marginal benefit. Now. Yeah. There should be. I really want
SSRN in a couple weeks.
I really want to see that. Like, am I getting academics tenure? But anyway, if you quote me at the beginning of your paper, it probably does increase your chances.
Yeah, definitely.
So
surefire
just something to think about. Anyway, yeah. So they wrote this paper about IPO pops, which we talked about on the mailbag episode of our podcast that was aired most recently.
You have to sing it.
No.
The mailbag episode. We did.
And this paper sort of formalizes an intuition that I've long thought about, which is that when you do an IPO, you're a company and you sell in the IPO something like 10 to 20% of your stock, right? Mm-hmm. The rest of your stock stays locked up, right? It's owned by the CEO, it's owned by the early investors, it's owned by the employees, and it's locked up in the IPO, so they can't sell for like 6 months after the IPO. Something like 10 or 20% of the shares come loose in the IPO. But most of those shares, most of the time, are being sold to like long-term investors who have had conversations with management and who management wants to be the shareholders. And so there's this sort of deal where the management and the bankers and the long-term investors are trying to like send the stock to people who will hold it for the long term. And what that means is that when the stock opens for trading the day after the IPO, there's not a lot of stock to buy because, the company has sold 10-ish% of its stock, and then 90-ish% of that stock goes to people who don't sell it on the first day. So the amount of stock that's available to buy on the first day is on the order of 1% of the shares outstanding. And meanwhile, there's all these retail investors who want to buy stock. And so when there's a hot IPO that a lot of retail investors want to buy, there's just not a lot of supply for them. And so the stock trades to a price that equilibrates supply and demand for like that 1% of the shares that the retail investors want to buy. But that doesn't tell you what the company is worth necessarily.
Yeah.
And it also doesn't tell you what the right IPO price was. Because the IPO price is the clearing price for 10, 15, 20% of the stock. But then, 1 or 2% of the stock trades on the exchange. So the clearing price on the exchange is going to be a lot higher than the clearing price for the IPO if like there's a lot of demand on the exchange.
Yeah.
But if like all 10% of the stock came loose on the day after the IPO, it would probably trade at less of a pop. And so they write about like, there's this question of like, how much money are companies leaving on the table that we talked about, where like people get really mad that when a stock doubles on its first day after the IPO, they say, oh, the bankers should have set the price higher so that it wouldn't trade up that high, and the company left all this money on the table. But that's not necessarily true because most of the stock doesn't trade on the first day.
Yeah.
They couldn't necessarily have sold 10 or 20% of their stock at the price that it rose to on the first day.
Yeah. This paper, it's a really good time for this paper because I feel like this topic has taken on new life because we're getting IPOs again and we're seeing...
Right. I was going to say, like, this is an evergreen topic. I've been thinking about this for like 15 years, but you're right. Like, for a while, it went pretty dormant because there were no IPOs.
Yeah, absolutely. And then 2025, I feel like you've seen really dramatic pops. Even in the last couple months, you think about Figma, CoreWeave, Circle. We were talking like triple digit, multiple 100% pops.
Right. And you think about like, you're a institutional stock investor, like you do some valuation work, you meet with this companies, you think this is what I'd pay for this company because it's comparable to like other companies in my portfolio. Maybe you own other private companies, right? Because a lot of institutions do. And then like the stock opens for trading and retail investors haven't had fun new IPOs to buy for years. And so there's a ton of demand for very limited supply. And so the stocks go up a lot, but that's not necessarily reflective of where institutions would price them. Yeah.
I will say, though, we're not talking about like one-day pops. In the case of those three companies, Figma, CoreWeave, and Circle, these were like multi-week, mostly sustained moves.
I want to be clear. Like this explanation is like an interesting and important technical explanation for some of what happens in IPO pops. It's not the only explanation. Right?
Yeah.
There is a desire to underprice IPOs so that people who invest in the IPO make a profit because that's good for them and for the banks and also arguably for the company because it like creates investor goodwill. But this explanation is not the only reason that IPOs pop.
Yeah. It is interesting to look that they find that the average IPO share price pop is like 19% higher than the actual offer price on the first day of trading. 19%, relative to some of the IPOs I just mentioned, seems tame at this point. I don't think that would turn heads in quite the same way that, whatever happened to Figma.
This is a long sample, right? And like,
and 30 years.
Yeah. And like, I do think that the scarcity of supply means there's more kind of dispersion now.
Yeah.
When there's 2 IPOs a week, they're not all going to pop 100%.
That's true. It feels like we're a ways away from that. Like I know that the IPO market is normalizing.
I said 2 IPOs a week. That's a low number. I feel like there used to be a lot more than 2 IPOs a week.
2 IPOs that people are excited about a week, though.
Right.
That
we're
seems
now
like
pretty low. Yeah.
Yeah. It's been grim for a while.
And now it's great. I think that this dynamic here where like very little of the shares are available and retail wants them, and so the stock pops, is exactly the same dynamic that you see in the private company stuff that we talk about all the time. Like retail and retail-ish, like, accredited retail investors really want to own shares
dentists,
of like dentists really want to own shares of OpenAI and SpaceX. It is hard for a retail investor to buy OpenAI and SpaceX, but it's not impossible. There's like little bits of OpenAI and SpaceX and like little, there's like secondary funds. There's like little, closed-end funds that own a little bit of it. And because there is a limited but not zero supply available to retail, retail really bids them up. And so the prices of, OpenAI shares or proxies or SpaceX shares or proxies on the retail market, the price is much higher than what you see those companies raising money at, right? And it's the same story, right? Like institutions will buy tens of billions of dollars of OpenAI stock at some price, and then retail investors will buy tens of millions of dollars of that stock at some much higher price. That doesn't mean that like OpenAI's valuation is in the trillions of dollars. It means that the supply available to retail is really low. And it's the same thing with IPOs, right? Like the supply the first day available to retail is much lower than what institutions have access to. And so the price is higher.
I feel like I'm too tired to like neatly make this point, but it does seem somewhat parallel to what we're talking about with MicroStrategy and the premium, and it's just coming down to supply and demand.
Yeah. I mean, I guess it's true in the sense that MicroStrategy, unlike OpenAI or these IPO or Figma, MicroStrategy is pretty much willing to supply whatever is demanded. And that is bad for the premium.
Exactly. And also to tie it to the first thing that we talked about, those retail investors don't need to try to own OpenAI. They just need to make a prediction market around it somehow to reflect the movement of these.
Oh, I write about that all the time. Yeah.
Well,
but there's legal complications there too.
Yeah.
Because like that's not a commodity. That's a security-based swap. Completely different problem. Let's leave it there on that very boring note.
Yeah. Well, that was awesome. I think that was really titillating.
And that was the Money Stuff Podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on Open Interest between 9 to 11 a.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net. Ask us a question and we might answer it on air.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff Podcast is produced by Anna Mazarakis and Moses Andam.
Our theme music was composed by Blake Maples, and Sage Bauman is Bloomberg's head of podcasts.
Thanks for listening to the Money Stuff Podcast. We'll be back next week with more stuff.